Hi, my name's Andy Day and welcome to M&A Q&A. Today we have my good friend Steve Quah. Steve is the CEO of Aroma Communications PLC, as well as its main agency, Cheerful 21st. Cheerful 21st is an award-winning live communications agency specializing in events, digital, creative and video. Steve started his career heading up his own live events agency, 21st Century Productions, which he exited in the early 2000s. Steve then went on to head up the good agency, brand experience and digital services before an opportunity arose to join Cheerful Scout PLC, where by a strange twist of fate, he was able to acquire his old agency, 21st Century, back, and Cheerful Scout became Cheerful 21st. Steve eventually ended up running the business and buying the retiring directors out. So now as head of the rebranded Aroma Communications PLC, Steve, with a fresh set of investors in the business, has been busy building the company through organic growth as well as several key acquisitions. Steve is a brilliant M&A negotiator when it comes to closing deals, and he has several acquisitions under his belt at Arema, including 2 last year. And Steve, the share price is up.
Is it?
How are you doing?
The share price is up. I'm very well, thanks. I'm very well, thanks. Thanks for the intro.
So we're going to kick off with a quick background check, as we always do with our guests. So Steve, tell us a bit about how you got into the events agency world.
Sure. Hello to guys on the screen. Very fortunate with a mixture of luck and being in the right place at the right time, and very young, left school, very talented in design and computer science, and I managed to get a job at the age of 18 working for a company called Electronic Arts. And it's not the EA you know, but at the time, they're one of the first computer graphics houses making animated videos and films for the TV, but they had what was known as a stills division that made slides, God, that many years ago, slides for conferences. And I joined there as a trainee designer. And after 3 years, I was studio manager. And at the age of 21, with my business partner to be, we decided to start our own agency, making graphics for the conference business. So that's how I got into the industry. In those days, it was on-screen content, slides, and some video production. And over the years, that the small, if you like, the graphic part of the business morphed and grew, and we just kind of got a bigger part of the live event piece. And eventually it became a full-blown events production agency, grew that business, and as Andrew says, grew that up, and actually sold that business in 2000 after building it up over about 15 years or something.
Right. So I didn't actually realise that about you, Steve. So you've always worked in conferences. I kind of had the inkling that you were involved in events in like the party sense.
No, exactly. I was involved on the on-screen side. So
on the conferences side.
On the conference side, yeah.
So that business that you sold was 21st Century Productions. So that was video and slides and everything around the production side of conference.
Yeah. Organizing, production.
And so after you sold that, you eventually moved into what was then Cheerful Scout PLC.
Yeah.
And what was your role there? Were you doing the same sort of thing, or?
Well, I had, as I say, I had an opportunity to kind of acquire back the business I sold, and I can talk to you about buying a service company that just involves principals and the dangers around that. And was looking for investors and backers and a partnership, and I just happened to know the chairman of Cheerful Scout PLC was an old client of mine, so I rang him up, and the basic proposition was I had loads of event clients and some film clients. They did loads of film and had some event clients, so we joined together, and I joined into that group, and that's my primary directive was to head up the events division and grow that side of the business. So and that was a very successful joining up, obviously.
Well, yeah, and they renamed the whole company eventually, I assume.
Yeah, I mean, the Cheerful Scout was the film production side, good reputation. 21st was the event side. For actually 2 years, we traded as 2 separate companies within the group, and then we merged that together and put the name together, Cheerful 21st, which is the bigger part of the agency business. We did acquire another agency last year. Yeah, that was 11 years ago now, I think.
So it was a rather unique way of getting your old business back under your control. But also you ended up being the major shareholder, or one of the major shareholders, at Cheerful Scout PLC. Can you tell me a bit more about that? Because I've only really heard rumours and inklings about how you managed to do it. Well, I know it's an interesting story, so whatever you can give us about.
Well, I wouldn't say it's a master plan. I think it's driven by value to the business. So, you know, by earning your stripes and earning your value. I mean, part of myself joining at the beginning, there was a share option scheme awarded to me to join a public company. That's one of the benefits of joining a public company. And by growing the event side and becoming such an important part of the business, the shareholders also wanted to reflect that within, you know, looking after, if you like, the key stakeholders, i.e. myself and my team. And it became so successful, and we were so ambitious that the 21st bit kind of morphed and became the part of the Cheerful 21st business. And along that journey, at the time, the original founders, who are great, if you like, colleagues to get me started in the PLC side, were also reaching a stage where they probably weren't as ambitious, also wanted to retire. So there was a time when I could say, look, guys, there's an opportunity where I can go and raise some money. I can go and do a kind of little mini roadshow, get some other investors involved, buy your shares out, and then they'll take control of the business, which we did, and raised the money quite quickly. So in essence, they exited and retired. They left myself and my colleague Andrew Harvey, who's the MD, with the fact that we had inherited a public company, very profitable, with great clients, with the fact, okay, what do we do next? And part of the reason behind kind of pushing for that as a public vehicle is that historically they had never really leveraged the fact that we were a public company, we could raise money, etc., etc., and entice kind of people to join us. So this was 3 years ago, and two missions: one to kind of stabilize and grow organically, and the second one was obviously how do we grow inorganically, mergers and acquisitions being obviously part of the strategy going forward.
Okay, so I would say that's a fairly unique way of sort of inheriting a PLC. But I think it's sort of a little bit like a reverse takeover in some sense, in that they kind of acquired your team into the business. And then eventually it outgrew the business that it was in. And
it's a little bit like that. It's a little bit like a small SPAC, to be honest. So there was an entity already there, and then they wanted to acquire similar businesses, and then we ended up being bought as a limited private company, and by default became a public company. So quite unusual, and also we're very small. And it's not like it was a mega public company, with hundreds of million turnover. It was a fairly small turnover, £3 or £4 million worth of business. In essence, it's actually too small to be listed, to be honest, because there's an overhead for being public. But then that was the advantage. We were quite unique, so therefore I've leveraged that. Both were obviously from an investment point of view, but also from within the industry, as in, we're a public company, very robust and very strong. So, but interesting to how, if someone told me that at the beginning, I would have said, no way. But there you go. So I ended up being a CEO of the PLC, and obviously the operating company, Cheerful 21st.
Yeah. So you've rebranded now as Arima Communications PLC. Is that correct?
No, Cheerful Scout, which is an odd name, PLC. We rebrand as Arima to be more generic. So in Arima now, there are three kind of operating companies: there's Cheerful 21st UK, there's Cheerful 21st Inc. in America, and there's Eventful Limited, who's part of one of our sister agencies.
Yeah, we'll get onto that in a minute, because that's one of your acquisitions that you've done quite recently, isn't it? So since you've been in charge of the business, you've had the strategy of buy and build, and I know you've made some smaller acquisitions, like there was a corporate meetings and incentive agency, for instance.
Yeah.
But how would you describe that strategy that you've got in a bit more detail?
Well, the first thing to say is, like, it's very easy to say I'm going to buy a company. bye. You know, look, I mean, just rewinding to more brass tacks. The fact I was in a position where we had a lot of cash in the business. We actually have built up a war cash for two reasons. One, the event business is quite lumpy. But secondly, it was to go and acquire and, you know, get businesses to join us. But it's all very well saying that, but actually, as you know, Andy, trying to find the right business, the right fit, the right personalities, etc., is somewhat challenging, to be honest. For a couple of fundamental reasons. Yeah, first of all, if you go around and actually are overtly saying, look, we are looking to buy, then that tends to flatter people's expectations of the company you're trying to acquire, as in their value. It is other end of the spectrum is that you don't want to be seen, particularly in the recent crisis where you're picking companies up because they are, I hate the word, cheap, or they're in trouble or in distress. There is an opportunity there. So you got to go back to kind of, again, what are you actually trying to achieve out of this acquisition thing? Actually, ultimately, are you trying to grow your business? Obviously, are you trying to grow your profits? Are you trying to grow your shareholder value? Are you trying to grow market share? Are you trying to extend your footprint? So, I mean, and that's just basic business planning. But going specifically, you also got to try and keep it simple. So, look, we do this type of event. So, Eventful, who we acquired beginning of last year, do another type of specialist event. So, therefore, it was that makes sense, and you can check and get a feeling and get an understanding for the clients, their financial position, and start on a smaller scale. And I think Eventful was a smart acquisition, very profitable business, fitted in nicely with us, and went through a very natural conversational stage. And you have to do quite a lot of courting. There isn't a magic formula to acquisitions. And if you want to look at the things that I would look at, number one is actually the chemistry between either the principals or involved in the business and where you think they will fit in your organization. Second is never make any assumptions. Okay, I mean, that sounds obvious, but never make any assumptions or get excited about their client list. I'm not referring back to our acquisition, but other acquisitions that have come close. You look at their client list and you go, the simplistic thinking is, oh, we can get work from their clients, they can get work from our client. In reality, that rarely ever happens in my experience, because I've been in other organizations, other group codes. It rarely ever happens for lots of reasons. One, clients perceive certain brands in a certain position, and it's quite hard to, from a client's perspective, to say I do this as well as this now. From a group perspective, you are promoting sometimes at slightly cross purposes to the conversations with the company that you actually has joined your group, because once they're saying one conversation, suddenly now they're saying a different conversation. And the other point of view is that there's always going back to kind of what's in it for the person that you've either acquired or you've acquired. And then that's probably the challenge for any sort of merger and acquisition to do around revenue splits, share of profits, and how the remuneration comes in, complicated probably by an earn out, complicated by whose clients, actually where do clients sit within a group. So but tricky.
So we've had somebody on here before as a guest, and they were talking about acquisitions that they've made, and they made 8 acquisitions in a 2-year period. So very quickly, with a blank sheet of paper business as well. So there wasn't an agency there to bolt things on, but they kept all of their acquisitions in silos, and they haven't integrated any of those businesses at all. Are you saying that actually the Eventful business is kind of, it's in the group, but it's been difficult to integrate those two businesses for the reasons that you just mentioned?
No, I mean and Eventful hasn't been difficult to integrate, but I'm saying where just past experience and other kind of situations, I think that's a challenge for when you're actually looking at acquiring a business is that integration piece.
Right.
And what I mean about that, so the way we operate is actually there are separate brands and they're actually separate P&Ls and they have a separate kind of management structure and have a reporting structure up to an exco level, and that works very well. And then it gets down to the language of what are you trying to do? Is it a merger or is it an acquisition or are you just adding another company to your portfolio? So yeah, and I think they've all got sort of pros and cons, but I think what you have to be careful of is when I go back to assumptions. Sometimes the companies that I have talked to in the past, not the ones we acquired, is that the assumption is by joining a bigger group, they're going to get a lot of business from us. So but of course, that's not the reason we're buying them, because the reason we're buying them is to generate more business independently from us. So, and then that sometimes gets lost in translation.
Right. So that's a good point, actually. So it's more about finding new revenue that you can bolt onto the core business, or the ownership of that, and the distribution of the profits. But it's not actually about looking for ways of cross-pollinating between the two.
No, I don't. That shouldn't be your driver. Eventful is a very distinct business in itself, and that is bought to grow the business. They joined us to grow their business. Right. To grow their business. By default, it helps the group. Cheerful 21st is growing by default, has a sister agency that we can use in, but ultimately the strategy at the moment is they run as separate companies with the idea to kind of grow that going forward.
And the strategy then is almost like you're bringing in these new companies, and by mentorship and association with the core business, that you're able to help them grow and then grow their revenues, and that's good for the group.
Yeah, totally. I mean, I think Eventful, quite a small agency, but had a great reputation. The principal owner was looking for the next thing in their career. They weren't looking to exit. That was attractive to us as well, and we saw an opportunity to grow, and it completely complemented our services. So it was a very natural fit. And again, in my experience, it was quick. From the first meeting, we knew we were going to do a deal. Again, as I say, we met lots of agencies along the way. We think, well, how's this going to work? So again, it's going back to that sort of chemistry and fit proposition. You can get involved in strategy and business plans and market share, etc. That is part of it. But I personally believe at a certain size, it's down to personalities and fit within the shared vision of the group going forward.
I think that's something that's stuck with me as well with our work together, is that we talked about chemistry quite a lot, and I still do it in our business in Capital A with my team as well. We talk about looking for chemistry between companies. So it's interesting that's number one on your list. The chemistry and fit is more important than finding a reason for the two companies to have.
Yeah, I mean, I'm probably speaking from a point of view as I'm very close to the business, because these are people I'm going to have to work with. So therefore, if I don't get on with them, or they don't get with us, that's a problem. Yeah, it doesn't matter how brilliant you are. And again, different size, different scope, different means. Again, if I wasn't that involved with the size and shape we are as a business, or how we operate, because we're quite a close kind of operating between the two businesses, then that may be not as important, but it would affect someone else in the command chain. And that's from my experience in being in other group mergers and other companies being part of an acquisition, which is the first time I bought my business. The biggest issues have either been non-clarity in management roles and responsibilities and reporting structure, non-clarity about where does the money sit and reside in profit, and also just people not understanding what each other's value and position is, or what their agenda is. So you need to be quite clear about that and very straight about that. And again, don't assume anything. And of course, we can talk about understanding their numbers. We can talk about understanding their clients. We can talk about understanding about that. But they're secondary. I personally believe it's down to does it look right? Does it smell right? Is it going to fit? And is it going to happen? and then do I think I'm going to be with them in 5 years' time with a growing business? Great. Of course, there is another mindset that, you whatever your guys on this call, whatever your plan is, if your plan is to get out in the next few years and you're building something up, you may take a view and go, I don't care. That's not important because I'm going to be gone. And what is important is building this business up to certain values. So again, it's mixture.
But your strategy has been based more on chemistry because you're here to build for the long term. So
Chemistry and
and can you explain just what the structure of the business is now? From the point of you have this PLC and it buys businesses. How does that end up working? Who owns what, and how does the structure of the business?
So Arima Communicate, the PLC, the AIM listed vehicle, they own 100% of all the operating companies. So America, UK, and Eventful, they own 100%. So I sit there's a PLC board with our chairman and two non-execs, and myself and Andrew are the operational directors. So we sit on the PLC board. So the PLC board has a PLC function as well, and to do with compliance, etc., etc. Then the operating companies again have a similar structure. Eventful has an MD. We have an MD, and I'm CEO of Cheerful 21st. But to be honest, there's what we call an SLT structure, which basically everyone reports into that. The PLC board at this stage is very functional around being just the public facing and doing around, as I say, compliance, interims, results, analysis, chairman's statement, that kind of stuff. And from an industry point of view, the shop windows are our brands, Cheerful 21st and Eventful.
Right. And then going forward, is the plan to Martin Sorrell the whole thing and keep pumping cash in and making acquisitions, or?
I'd say, look, and again, I'm just saying, one day you can say, I'm going to take the world over, because we can raise, being public, you can raise any amount of money. The honest answer, no, we just want sensible growth. We want to return value to our shareholders and be one of the shareholders who want to do that. I think when it starts becoming completely a public business about the business of brands and not the actual work you're doing, that's a different world. Martin Sorrell was just a clever person at putting businesses together. He wasn't an expert. Well, the business was about putting businesses together, whereas we're still about being a creative agency group.
Right.
But to answer your question, look, we will use the public side of the business when we think it's sensible. We like growing organically. We like making smart acquisitions, and we'll continue to look at smart acquisitions. We're in no rush. Again, we do have a long-term plan. We're on that path, just like any business, and being public or not public is the same thing. Mm-hmm. So you can get carried away about being public, though. Hey, we'll make money, and then you watch your share price go up and down. And I can talk about the virtues of being public maybe later on, but I mean it's interesting. Yeah, it's very different from being a limited private company, guys.
It does add a little bit of extra enjoyment to it, though, surely.
You understand that you can understand markets where you can make a lot of profit and your share price can go down. You can make a lot of revenue and no profit, and your share price can go up. Go figure. So so it's interesting, and there are pros and cons to every sort of business vehicle, public, private equity, whatever you want to, however you fund it.
Okay, well, I'm going to ask you towards the end a little bit more about the whole PLC thing. So having worked with you guys, I know the way that you run your acquisitions conversations. So you'll have several of those running at once, and you really sort of dig deep into the business. And I think, like you just said, sort of there's no rush to do any of these acquisitions, really. So, and that really is something that I've seen. You're kind of under no pressure at all to move forward with an acquisition until you're 100% happy. And because you're so patient, you end up doing really amazing deals. The deals that you have closed have been really favorable for you as well. And I think you once said to me about having to kiss a lot of frogs, and that really stuck with me as well. So how do you resist just going on a buying spree or marrying a lot of princes?
How do you resist? Well, you do resist, but it's not. It's how can I say? I enjoy and I'm very happy to have conversations with anybody about anything. And on paper it may look completely an odd conversation. That's the first thing. I think part of the skill is actually really being quite sharp with your conversation and very straight to the point. And the comments that I've had in the past is that kind of what you see is what you get. There's been no hidden agenda. We're very straight about things. We'll ask very blunt questions. If we get correct answers back, then it becomes an honest conversation. And yeah, you have to talk to a lot of people. As I say, going back to that assumption thing, you just don't know why they're having that conversation. You want to find out, is it a genuine reason why they want to kind of grow and expand? Is it a genuine reason why they want shorter finance, or have they had near missed experiences in the last 2-3 years where they've been, haven't had enough money to pay this pay bill? It's all those sort of things you need to find out. And then that's why we wait, because there's on paper, there's a lot of agencies that will go, we should acquire them now, do it. And one that may be a policy one day, depends where you want to go, but not our policy. It's been, conversations. To be honest, the deals that have happened quite quickly. Right. Because it's been right and there's been a mutual understanding and it's just been fast tracked. And the ones that haven't happened, is probably by the third meeting, you still haven't told me what you do. Conversation, and again, it's just breaking down the barriers about what is their value. Mm-hmm. And then that gets to get more complicated, because by default we're buying service-based businesses. Service-based businesses generally don't have much IP or productization, so therefore you're buying relationships, expertise, and clients, and they're usually attached to, as you will find out, a handful, if not a small number of principals within that business. So in essence, that is what you're buying, i.e. their brand and their reputation, which is tricky, because going back to my earlier conversation, if you don't get on, then that is your business not getting on. It's not like you've got a factory or anything like that. So yeah, there you go.
So those, so we just talked about those last couple of deals that you did last year. So you just mentioned that they happened quite quickly, and actually that is my memory of it as well. They kind of came very quickly to the table and closed very quickly. It was Unicorn Events and Eventful.
Yeah, and Eventful was
a little bit about those deals.
Yeah, so
not reveal too much detail, but
Eventful was a business we were talking to. I was introduced by a mutual client. Again, that's not a great way to know another brand or an agency, as in they had done part of the event supply to one of our clients. They'd done the venue research on the hospitality side, and we have worked with them for 3 years. And actually, we kind of worked remotely. We didn't know each other, but we knew of each other. Then we met, and it was obviously, it made sense. Because one, we had some mutual clients, and two, Caroline, who was the MD, was of the next stage in her career, and just like kind of cut of our cloth, and the conversation was very quick. She'd also been through a process of talking to lots of other agencies. So again, part of that was also Eventful knew what they wanted to do. And then we agreed to terms. The terms are favorable for both parties. The terms are fair, and we did a deal. Unicorn, again, I must be clear, Unicorn was not an acquisition. Unicorn over more strategic hires. And that was, again, conversations I had with the MD of Unicorn. She was in a position to kind of exit Unicorn with some of the team, and we joined us as strategic hires. Again, very quick, very mutual belief in the same sort of values, and then that happened pretty quickly, and kind of bolstered our team. So that's where we landed on with Unicorn. and they've been both very successful. Eventful, had a knock because they do a lot of live stuff. Obviously, COVID's had an impact on that. And the strategic hires that we have done, which in essence are basically, going back to my point, principals involved in the business have their clients, is been successful. And then that is another way to grow your business, is strategic hires. It's very low risk. And if you're generous and you do a hire on a equal footing as in peers and colleagues, it works really quickly.
So in the agency scenario in particular, then, by making those strategic hires of principal people who are in other agencies or maybe even own other agencies, instead of going and making an acquisition and getting dirty, getting involved in all of that, much easier to laser focus on those individuals that have really good relationships and can bring contracts with them.
Yeah,
that's a very cool piece of advice. Actually, we've not had that one before. Definitely good.
I would say that should be what you do most of the time. I'll be honest with you. Acquiring companies is expensive, and it's fairly high risk. Getting great talent to join you for a belief in what we're going to do together is so much more powerful and so much more productive. And from a shareholder point of view, is a lot less risk because you're not buying an entity. Now, it's again going back, and so if we wanted to grow by 100%, then you can't do that. You're going to have to do some acquisitions along the way. And if you want to go into a certain market sector, you can't do that really without buying in the credentials. So if you want to go into automotive, and you've never done automotive before, then that's another reason that you want to acquire a business, because they have automotive clients and you're in. But I'm very much a people person, and not mega Inc. Although we're a public company and doing very well, but that's probably why we're doing very well. It's about people, clients, and relationships. Right. And that's ultimately buying, and that's the strength, and that's the challenge too.
So I was going to ask next, Steve, what a winning piece of advice would be on making acquisition, but maybe it's even more general than that. But what would you say is a good piece of advice when it comes to making acquisitions from your experience?
I think first of all, you got to be quite clear about, and that sounds obvious, but what you really want to do with this. This is not something you try. This is not something you think will work. And I go back to that assumption. And it's not something you think's a good idea. Okay, it has to hit all those things, as in absolutely makes sense, fits with our strategy, and the risk of it failing is manageable. Okay, therefore you can go from a comfort point of view. I wouldn't want to go into a relationship where I'm counting on them or any acquisition to be generating profits from day one. You obviously want to acquire, but I'm assuming that the worst case scenario is that it might. So you got to be clear about how you would manage the rough times as well as the good times. Yeah, that's probably the best piece of advice is don't get your corporate ego in the way. Don't get your personal ego in the way, and be very honest and realistic and say, like, what is this really going to be like? And if you have a nagging doubt, if you go, well, I think don't stop. I mean, don't bother. To be honest, it's too much effort, too much time and energy. Then you've also got to, I mean, this is like, mergers for dummies, rule but one. But I'm just stating the simple, obvious things that are important. You've got to be also clear about how you're going to manage conflict. Okay, and I go back to that point of view about conflict could be with staff, and you've got to manage maybe conflict with clients, and then ultimately, we really haven't touched on that, is if it is a merger then it's a culture clash or acquisition. If it's an acquisition, it's slightly different. So again, you can hear what I'm saying. It's a lot about people and personalities, but that's because that's my industry. It's people. It's not software, it's not products, it's not fashion, it's not retail. We're a service-based industry. Was that one piece of advice? Yeah, and also gut feeling's good. I'll tell you.
Yeah, gut feeling's a good one.
Gut feeling's a good one.
I think I've mentioned that one as well. I think quite early on in conversations with companies, quite often you get the feeling. You can't really see it for definite, but there's a feeling, there's a bit of attitude or something's not quite stacking up with the other person.
Yeah.
And my recommendation is, if it starts to feel a bit weird, you've just got to walk away very quickly.
And then the best piece of personal advice I could give is that you want to be surrounded by people smarter than you are. Okay. That's my advice. That's like, what do you want? Why do you want a business, Steve? You start a business when you're young and you get I've got my MD business card. I'm a managing director or forget that. I'd rather be a sleeping director for the brilliant people. Okay. And that's probably the success in the conversations I have, because it's not about me at all. It's about, I see something in you, or my group does, representing my shareholders. We think we can make something better out of this. Then you can instantly see, when I start talking like this, then people would start going, I start to believe you. If it's like, I'm going to take over the world, going back to your thing, that's not what you do. Yeah, some people can do that. The personality of the owner is bigger than the brand. Yeah, right. But no, it's
well, I think you're being very humble there, Steve.
It's okay.
Because you are one of the coolest people that I've ever met. I mean, you're a cool guy. So, I'm pretty sure. I'm pretty sure your team, are pretty enamored with you as well. Very cool person.
Thank you.
Look, let me just ask you a next question. I don't want to get stuck blowing too much smoke. Every week I ask our guests about financing deals, and we've not had a PLC CEO on before. So with a PLC, you kind of have a few more options maybe, in your toolbox, because you've got shares and they're more liquid and they can be traded. Plus, one of the things I seem to remember you do offer is like a seat on the board, which does sound really exciting to be on the board of a PLC. But what does a good deal look like from your perspective when it comes to offering a good deal, and it works for you as a CEO of a PLC, and it works for the company that you're acquiring as well? What does that look like?
Yeah, so this sort of touches on the advantages and disadvantages of being a public company stroke a private company.
What are the advantages?
And the fundamental differences is obviously that your share price actually has a real value because it's traded on a stock market. So therefore 100% of a private company is worthless unless you can sell it to someone. 100% of a public company is worth a lot of money because you can sell it to a lot of people because it's a traded stock. So there's your fundamental difference. Pros and cons though are that your share price can go up and down. So the value of your business publicly can go up and down, whereas in a private company, do what you bloody like, basically. But the advantage is that part of the attraction of when we're talking to potential acquisitions and mergers is the fact that we are public vehicles. Then one, if we're going to do any sort of equity or paper swap, as they say, therefore they immediately have a tangible value. So therefore we can put a value on those. So if our shares, a shares are 10p, and you want 1 million shares, so there's 100 grand. That has a value to you. Yeah, and it's very different from saying, or you can have 49% of a limited company. So therefore, you can trade it. So it's a monetary value. Right. That also has then the benefit is it's also quite easy to give those shares. So therefore, it's an easier mechanism to get the principals involved with some skin in the game because they own part of the business. Again, in the private situation, can get quite complicated. I've experienced, particularly with limited companies, when there's usually like 2 or 3 directors, they've got 30% each. they'll cry over giving 5% each to someone new or something. You know, they don't realize the fact, you know, the value is, I'm not actually your share, the value is your business and a piece of that. But anyway, so what's a good deal? Yeah, some paper from us. So, but in essence, of course, that doesn't cost us any cash. We're just giving, so it's a dilution question. Then some cash on the table for the person we're acquiring from us, because we believe there needs to be, you know, a bit of a sunny day for them, as if it's not a rescue deal. If it's like, you know, we value your business at X, so of this pie, we're going to give you some as paper, skin in the game. We will give you some cash, and then we'll have some sort of earnout mechanic. And if I'm being really fair, the earnout will be geared so we don't lose money. Yeah. So from a seller's point of view, if your break-even number is this, you'll get your earnout as long as you break even. Okay. So again, they feel comfortable with that, but we're not going to lose any money. Where you say you've got to do 200,000-300,000, it just puts a whole different dynamic on it. So again, it's just, we value your business today because you've got shares in our business already, because there may be future options, therefore you're building the value up. So therefore that's actually when you're going to get your return. So that'll be one deal. The other deal is, yeah, it could be, I mean, it is a million one options. So that's someone who wants to join and grow with us. Someone may want to retire. Then of course that's a different conversation, but it will be a variation on that theme of some paper shares from us and some cash stroke, some sort of earn-out fee.
So if you had a limited company, you could offer the same kind of deal, but obviously those shares in a limited company are, you know, difficult to get rid of.
Yeah,
so the benefit is you're almost printing money for your own deals, which is pretty good.
Yeah, I mean, I think the that's always the tricky part of buying a private company is actually the shareholders being aligned, or because there's usually like common conversations are there's two people who really want to sell and one doesn't, or there'll be a conversation is like he or she doesn't want to keep up with where we're going, but how do we get rid of them? So there's all that sort of, and you know, that's a funny dynamic, you know, because you're like, okay, but that's not really my problem. I'm buying your business, but that'll be part of the conversation. But going back to the deal, but again, I'm very open to all sorts of deals if it's right. You know, if someone, for whatever situation, really is going to retire and, you know, surf in Hawaii, then we'll go, okay, we'll flex accordingly. So, and of course, but the downside is, you know, if our share price drops, then obviously our buying power drops. If our share price halves, then using paper as part of the deal is twice as expensive. Right. But it's a very I like the rigor and the robustness of being public. I like the fact of disclosure and being absolutely white and white, and you know, we have to have nomads and brokers that keep us in check. I think it's a very good discipline, and our clients like that too, particularly in COVID, where they can see how strong we are financially going forward.
Okay, so on the subject of PLCs, and you mentioned SPACs already, we're hearing a lot about SPACs at the moment, but I suppose from a sort of limited, a limited company, which most of us have that kind of experience and that background, the whole sort of, you know, thing about PLCs is kind of a mystery, and IPOs and floating on the stock market, these are all kind of magic phrases that we don't really get to play in that world. But would you encourage agency owners to look at floating as an option, or reverse takeovers, or SPACs, or, you know, direct listing? Would you encourage that?
Yeah, well, it's a good question. You got the first question is asked: do you want to be public or private? Okay, and then public is a whole world of compliance and stuff that you will find frustrating if you're very used to being a private company. Right. But I'd say it's what scale you want to be. You got to be of a certain size and scale to do this. You know, you got to be a large business with huge growth potential, or have a plan that you're going to become, you know, a 10 million to 100 million pound business, to make it worthwhile, it's expensive.
Right.
To do an IPO from the bat off is expensive. I mean, you're talking £300,000-400,000 to do that. Likewise, with a reverse takeover, it's similar. It's expensive. So, I guess the attraction with the SPAC model, and then again, it's been around for years, by the way, but it's very, very, very popular. It's a, again, you got to see where's the money being made. Well, it's going to be by the people who set up and are the original sponsors who buy, you know, 10% for 25 grand a nominal fee.
Mhm.
Yeah. I'm not sure how it applies to creative agencies of a certain size, any IPO public offering. Okay. If you had privately said, right, I'm going to get together with X number of other agencies, and basically we want to fold into a business, and we want to make that, you know, the next Jack Morton or the next sort of imagination. I think a private imagination. Then that makes sense. But yeah, it's expensive. You'll be paying 7-8% in fees, and you've got to find a backer. Would it be Golden Smacks? You get the headlines, get the whole world of stuff. But I mean, I'm not sure it applies that much.
So so say I rolled 10 agencies together and we were doing 10-15 million turnover, at that point, would it make any sense to then either reverse into another business?
Well, what for? What are you trying to achieve?
I don't know. You tell me. You've got I mean, it's your business model, so I'm hoping to learn something. Would it be? Is it better in that we create that liquidity event and we can get some money off the table for ourselves, but also then go on to trade the shares and grow the business for the shareholders and the share price? Or does it not really make that much sense? Is it better to just?
No, well, I say that as in, like, I inherited a PLC. You know, there's many a time when it would be better for us to be private. There are other weird things about being a PLC. If we want to acquire companies bigger than us, that's called a reverse takeover. If you want to do that as a private company, it doesn't mean anything. If you're turnover 1 million, you want to buy a company of 30 million, you can do that. I can't do that without reverse takeover. Reverse takeover costing 300 or 400 grand to do that. But to your question, yeah, it's a vehicle to raise money, have shareholders, and grow your business. And and your ambition is to take your value in your business and then make it 10 times the value. And that's how you're going to do it in a traded share price. And that's so you want in your public deal, you want to be obviously one of the principals or the early founders or sponsors or whatever the mechanic is, that you have a huge return potentially if the share price doubles, triples, quadruples in price going forward. It depends on your ambition. I mean, it's yeah.
Well, I would say most people's, not everybody's, but most people's ambition would be to at some point have some kind of liquidity event to exit the company that they built so they can take some value out. So it sounds like going that route is more complicated and perhaps
it's expensive, but to that point, if you go public, then you obviously have some value, and if your share price goes up or stays the same, then you have a mechanic to leave. Just sell your shares. There you go. It's yeah, it's interesting. A lot of people make a lot of money out of IPOs that don't have anything to do with business, by the way. So
almost like a separate business. Well, it's good to get your perspective on it.
I think I think what it does is it gives you opportunities to consider, or where we could say, all right, we want to go and buy 10 agencies now in the next year. We could do. It's possible. You can easily raise the money and finance. So I guess that's the nice fun bit. But I'm already a public company. From the get-go. I'm not sure your background, any of these guys in here, but it's a serious step, because this is what Airbnb does, or Uber does, and IPOs are very expensive, and you do a financial roadshow, and you want to get people to back you, and
That's because your business is going to go from 10 million to be a 200 million pound business. That's why people want to invest. So again, if you've got an agency that's going to do that, you might want to say, I'm going to keep that private, do it myself. But anyway,
so that's an interesting point. So potentially it would be more fruitful to hang on to the shares and grow the business privately.
Yeah, potentially, or it may go nowhere. Again, going back to that private, being a private company, who's going to buy your business? Who's going to buy your shares? Well, either another private sale, who's going to buy it, or one of your sort of co-directors tends to happen, or a management buyout. Again, it's like it's great when you're all together, but if one of you wants to retire, then it's just tricky to exit in your, because people can't find that cash sometimes.
Exactly. So just getting very close to the hour now, so just wanted to ask you a couple more things. Are you working on any deals at the moment? Any ambitions to acquire any more businesses this year?
Yeah, as I say, I'm always having conversations, and as a duty of the CEO of a public company, we're looking at all opportunities. I'd be wrong to say if anything's happening in particular. Yeah, generally, yes, of course we're looking.
You can't tell us, can you? Because of
no, can't
because of rules.
No.
Okay, so.
But yeah, no, I mean, yeah, of course, but and public or not public, it's the same view as any business going forward. We're looking at, how do we grow the business? So, and merger and acquisitions is one of the tools. At the moment, organic and getting smart people in is just as effective, because particularly out of COVID, the industry's changed a lot. There's a lot of talent out there who are looking for homes to go forward.
Yeah. Okay, thank you very much for that, Steve. Can you just tell us finally how anybody that's on this call now can stay in touch with you or reach out to you? What's the best way for them to get a hold of you?
Yeah, email, LinkedIn. I'm sure if you give me the details, I'll send a link out to you guys.
Yeah. Okay, I'll share your LinkedIn profile.
I mean, I'll be curious the last few minutes of what anyone's real objectives are on this call. I'll be actually curious from you guys, actually.
Well, this is your moment, Steve. So this is where we open up everybody else's microphones. Good. And they get an opportunity to speak to you directly, and I step back. So thanks very much for your time, Steve. We'll just open the floor. Has anybody got a question?
I think Steve has.
Steve wants to ask you.
I'm just curious what your businesses are, actually, and where you are in your cycle.
Your office is my old office.
Is it?
Yeah. You bought the great the lease for Moray House from us in 2013.
Oh my God. Okay.
Yeah.
That's when we had to get.
That's how we know each other. Well, I know your business. I know Gary, I guess. Yeah.
Oh, okay. That's when we.
So I've left that business now, but my business is video games marketing services.
Oh, okay.
Yeah. And obviously the context of it is, very much from what Andy does here, which is to, kind of give us lots of points of, interest and information about different ways that we can approach this whole broad concept of acquisition and scaling. But I had a question for you, Steve, which was that, given what you say, I think about understanding the purpose of what you're actually trying to get to, but if we almost place that one aside, has there ever been a better time to buy marketing businesses with a large exposure to events?
Yeah. In what ways?
Well, it must be that. I saw what happened to your share price in last March. That's happened to so many other people with exposure to the events, that they've been through a very traumatic year. And the sort of disruption that's happened in that market could never have been bigger to so many people. So there's a lot of businesses there that are looking that this kind of cataclysmic event has set them a lot of people thinking about what it is they want to do, reevaluating the situation, the rest of it. Surely it must be the best time ever for deals to be done in that space.
Totally. I think part of the personal tragedy, COVID's been the best thing that's happened to us as an industry. And as an agency, we've grown 30% in the last 12 months. In fact, we're looking for a new office because if everyone came back to the office, we wouldn't fit in there because we had cash and robust and we did virtual and digital. But to your point, Will, yeah, absolutely. It's shaken up the industry. It's refocused. It's made clients also appreciate what they really are trying to buy and what is important as a value add service. And it isn't a warehouse full of kit, okay, for conferences. It's, we've always done comms and strategy first, and just so happens there's a live channel we use. We switch very easily into the virtual channel. But there's a lot of companies out there who have been completely whacked because they have had no work. I mean, we had 80% of our revenues disappeared last March. And to be honest, this year, we'll probably make that up in the last 12 months by just evolving and adapting. But yeah, it's very opportune. I think it's made people wake up. I've had lots of conversations with people who have gone, I don't want to do this anymore, but they have a good business and they want to get out for different reasons. And it's just, I describe it as a reset button for the industry. It was, there were too many agencies, in my opinion, pre-COVID for the amount of work out there. There was a bit of a race to the bottom for lots of products and services. And the stronger companies have either survived by the fact they still have a value service that clients want. Certain industry sectors have absolutely been decimated, as you know, like festivals and live and performance and consumer stuff. The experiential guys have been beaten up completely because obviously that's not happening. But in the corporate sector, and the fact we've hung in there, it's just amplified our skill sets. But yeah, there's lots of conversations going on, lots of talent. It's very interesting. Obviously we're being recruiting. We're getting some great people kind of joining us from other agencies. Going back to kind of the point I was making earlier, that it wasn't we're only recruiting senior people. It's just that good people have come, and there were XYZ at XYZ agency. We go, that's great. But yeah, it's an interesting time. It's shaken up what the live events business should be as well, really. And if you're doing anything with comms and digital and on screen with an audience that has then you're going to be in a good place. Virtual now is just another new channel. It's not a channel to us. Virtual will be here forever. Hybrid and live. In person will come back to really strong for the right reasons. But it's very interesting to see. Well,
great. No, thank you.
Anybody else? Robert, did you want to tell us a little bit about your business?
Yeah, hi. I do two separate things really around film production. So I've got one is more a traditional creative agency that creates content. We actually do a lot of live events and dealt with all of that trauma over the last year. And the other side of it works kind of exclusively with user-generated content for business. So yeah, it's I'm excited about it. I mean, it's been a tough old year coming through, but I've had an amazing couple of months, and I feel that what COVID did was just stir up all the waters, and it's given smaller kind of, if you like, I hasten to call myself up and coming, but I'd like to think I was an up and coming agency. It's given us an opportunity to kind of jump in and run against some of the bigger companies and give ourselves a shot. It's an interesting time. I haven't really got a question to ask you. It's just
no, it's good. I think to that point, Rob, I think it's been a great equalizer.
Yeah, I feel that. I feel that just that little mix kind of gave everything a refresh. And like you said, especially in the live events game and in the film industry or the video production industry, it's super fragmented and there's loads of people. It might like you said, it might change that race to the bottom that was happening, where everybody was just killing themselves to win the work. It was just getting more and more competitive. There was no money in anything. So I'm just kind of hoping it changes that a little bit, and we can go forward. I mean, if the last 2 months are anything to go by, then yeah, it's all good.
Yeah, absolutely. I think we also have a saying like he or she, they who own the pixel own the future, because everything's getting digitized now.
Sure.
It's just everything we're talking about on the virtual kind of experience and the digital comms piece around live is just accelerating a lot of stuff that was being talked about before is actually happening now. So we have the biggest part of our growth in our department is the digital technology side, the whole spectrum, whether it be kind of on screen or virtual or platforms or whatever measurement.
The power of the virtual platform is not going to take anything away from the fact that it's not going to do anything other than bolster the event offering. It's not people were, I think, initially worried about how that would affect kind of the live experience, but it just means people will put on more experience. Like they'll still do a live experience, but they might do a virtual one as well. It's more of an offering, isn't it?
It's good. It's just made we're crossing into where more traditional marketing, PR now, and agencies would have encroached. The live bit's always been here, and the comms piece has kind of been here. And then some of us say we do comms, but actually, by it's been digitized on the virtual stuff, is that we are getting much more grown up, earlier conversations about objectives. We're therefore working out a strategy, and just so happens it's going to be kind of a virtual event or a live event. So it's been very good for the industry, for agencies that can do that. As I say, if you're really a set and stage and production person and worried about F&B and the table setting and what color the napkins are, then that's obviously not where you're going to add value to your client.
No.
And the clients are quickly realizing, well, why that agency doesn't do that, does this? So it's interesting to see, Rob. Particularly in the exhibition market. Well, I'd like to see what happens with the exhibition market when it comes back, because some in-person things can't be replaced. The fact you're going to have a party, it's quite hard to do online.
We just got a quick view of Thomas there. Thomas, you want to say hello? And I realise we're going over the hour now.
I shoot my short pitch just not to take much time. I'm CEO and co-founder of a mobile advertising agency. We are focused on mobile performance. It's driving new users for mobile applications. We work with companies like Amazon, Letgo, Expedia, Deliveroo, and some other tier 1 and well-known companies. And COVID was challenging at some point because the clients change strategies too. So clients that were like pumping a lot of money on apps like Uber and Deliveroo retire that kind of budgets because they get the Deliveroo thing get users organically, and Uber was like not working. But other type of advertisers rise up, like all the trading applications, all the new banks like Chime, Barrow, that are huge brands in the US, like bank digitalization. It's driving a lot of money. So the players had changed a little bit, and we reshaped, but we are in shape. So we are on track.
Good stuff.
Jerry, are you there at all? Just is he there? No.
Yeah, I'm here, but I've got some noisy kids around me. So
yeah, and Jerry's our new MD, Steve, who you've not met yet. So.
Oh, Andy, what do you do now then?
Jerry's a simmer accountant, so he's the brains. You said surround yourself with more intelligent people. Jerry's that in my business. So, kids in the background. So thank you very much, Steve, and thank you everybody for the bit of colour towards the end. All good. Thank you for your time, Steve. Really appreciate it. I'm going to share the recording afterwards.
Okay. Thank you.
So,
guys, good luck with everything. Yeah, wish you well.
Thank you very much. Thank you, Steve.
Thanks, Andy.
Cheers, guys. Have a good weekend.
Andy.
Bye, Andy.
See you soon.
See you later.
Thanks a lot.